Under Armour stock is currently down 58% year to date. Now, this is a company that was trading as high as $21 per share earlier this year, but is now trading at under $9 per share. The fact that they've recently been removed from the S&P 500 has definitely not helped. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if the recent decline in their stock price has led to a buying opportunity. And on this stock spreadsheet, we're going to look at 4 different valuation models. We're going to look at Graham's valuation, a discounted cash flow model, multiples valuation, and a dividend discount model, and all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can jump over to my Patreon page at the link in the description. So the first thing we'll do is we'll come up here and we're going to plug in Under Armour stock ticker UA and hit enter, and we can see all of this data is going to automatically load in. Now, one of the things you'll notice is this is a company that does not pay a dividend. So typically I do focus on dividend paying companies, but today we're looking at a company that has decreased in its price so much that it may still be a buying opportunity for me despite the fact it does not pay a dividend. Now, if we look at all of these moving averages, we can say they're pretty down. 20-day moving average down over 5%, 50-day down over 18%, and 200-day down nearly 50%. Now, we're currently looking at a 365-day chart right here, but if we zoom out a whole lot more, let's say we want to look at a 5,000-day chart, we can see the price action for this stock has been pretty choppy. We've had a huge decline quite a few years ago, then it came back up, and then we obviously had the 2020 decline, came back up again, and now it's back down to its 2020 lows. But let's go ahead and zoom back into the 365-day chart. If we'll come over here, we can see analysts have a target price of $26.20 per share, and institutional ownership is sitting at about 67%. Now, this is something that I think is pretty interesting because as of recent, this is a company that's been getting a lot more attention from institutions. Fifth Third Bank recently increased its position along with a lot of other large institutions like Adage Capital and State Street Corp, along with a lot of other institutional investors as well. So they are starting to get a lot more attention, which does kind of make me think that this may be a buying opportunity. But let's go ahead and jump into our valuations. And the first one we'll look at is Graham's valuation. Now, Benjamin Graham was one of Warren Buffett's mentors, and this is the formula he laid out for us to calculate intrinsic value. The first thing we're going to take is the earnings per share, which is kind of low for Under Armour at the time. Now let's go ahead and multiply this by 7, which is the price to earnings of a company with no growth, and then we're going to apply our growth rate projection. When you look at industry expectations and analyst expected growth rates for this company, it's actually a lot higher than a lot of people realize. We're applying a growth rate of 20. We're then going to multiply that by 4.4, which is the average yield of AAA corporate bonds, and then we need to look at the current yield of AAA corporate bonds, as we can see right here, and that's what we're going to actually divide everything by. And at the time of this video, it's currently sitting at 4.2, which is much higher than it has been in recent months. Earlier this year, it was as low as 2.8, and if we look at what it would be with 2.8, we can see our intrinsic value would be almost $20 per share, but it is currently sitting at 4.2, and because of this, the intrinsic value is currently sitting at about $13.29, according to Graham's valuation. Now let's go ahead and jump over to our discounted cash flow model. And the idea behind the discounted cash flow model is we should be able to value a company based on how much free cash flow it produces in the future. So what I've done is we need to apply a growth rate to the future free cash flows. So to do this, I looked at the historical free cash flow and looked for their average growth rate. Now, when we look at this historical free cash flow, we can see it's quite choppy. There was an increase from 2013 to 2014, and then we had about a 3-year period where they actually had negative free cash flow. Now, from 2018 to 2021, we can see they have had pretty solid positive free cash flow, which jumped around just a little bit. But if we look at the past 3 years, we can see an average growth rate of about 100%, but these growth rates does not really show an accurate representation of the expectations for the future here. We can obviously see negative 31% here, negative 62% here, but then a huge increase of almost 400%. So really, this is not the best way to look at the expected free cash flow growth for this company. I would recommend looking at industry expectations and other analyst expectations, as well as looking into it yourself and making your own assumptions. So for me, I am applying a growth rate of about 12% for the future free cash flows for this company. So I applied that growth rate to the future free cash flows and the terminal value, which is the sum of all the future free cash flows past the year 2030. I then took the present value of all of these future free cash flows, as we can see right here, and then I added them together. I added the company's cash and cash equivalents and subtracted out their total debt to find their equity value, and then divided by their shares outstanding, which gave me a discounted cash flow price per share of $16.59. The next thing we want to look at is our multiples valuation. Now, I think the multiples valuation can be pretty relevant relevant in a situation such as this. We have a lot of great competitors for Under Armour who are similar in business and in structure. So essentially what we're going to do is we're going to use the multiples valuation and a price to earnings multiple to see how the market is valuing companies that are similar to Under Armour, and using that price to earnings multiple to value Under Armour. So for example, we're going to take companies like Nike, Lululemon, Ralph Lauren, and Levi. We're going to take their stock price and divide by their earnings per share to get their price to earnings multiple right here. We then take the average price to earnings multiple and we multiply it by Under Armour's earnings per share, and this leads us to an intrinsic value of $10.46 per share for Under Armour. Now obviously, like I mentioned earlier, this is a company that does not pay a dividend, so we won't be using the dividend discount model in this scenario. So we can go ahead and jump over to our output tab, and here on the output tab we have the three valuation models that we used in this scenario. We have Graham's valuation at $13, discounted cash flow at 16.5, and our multiples valuation at 10.46. And when we average all three of these together, we can see we come to an intrinsic value of $13.45, which is quite a bit higher than the current price for Under Armour. Now there's a negative 40% difference in the intrinsic value in the current price, but let's go ahead and apply our margin of safety. Let's say we want to be really safe and apply about a 30% margin of safety and hit enter. And we can see based off of this, our acceptable buy price for this company would be $9.41. So if you are a value investor who is comfortable adding a position to your portfolio that does not pay a dividend, this could potentially be a play that you may want to look at. As for me personally, I am sitting on a cash position while waiting to buy quality dividend paying companies. So this isn't a company currently on my watch list, but I did think that the current price was interesting when you look at it compared to its intrinsic value. So go ahead and let me know what your thoughts on this company are in the comments below, and if you plan on buying or selling. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.